to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Thank you. Well, welcome back. It's been a kind of an interesting week, actually. I had a lot of questions, a lot of people asking for services that prior to now, there was a reason that we didn't really offer them. Actually, we did offer them. It's just a slightly different form. So I've been working a lot on that and being able to deepen the level of service that we provide at Bullington Capital Management. And it's pretty deep now. It's actually really deep. And essentially, we help people try to plan for retirement, and mostly retirement income planning. If you are looking to accumulate enough money to be able to maintain your lifestyle, we try to sit down and work with that and try to simplify it. I see so many questionnaires, and they ask so many questions, and a lot of it just not necessary. And that's just kind of not how I'm wired. My upbringing was looking for efficiency. My dad was an independent contractor, the carpenter, and we built a lot of houses, room additions, garages. And in the greater Cleveland area, it's kind of funny. A lot of these garages were built in the early 1900s, and by the time I was in my early teens, they were 100 years old. So a lot of them were falling down. We would go in and they would knock them down and pour a new slab of cement if they needed it. And then we would come in and build a garage. And we would get a 16 by 24, that's 16 feet by 24 feet wide or long. You could switch those up. Garage that had a regular roof like a house, full siding. We didn't hang the garage door, but we would put windows or regular doors in the garage. And we'd get that done in about 8 hours, and there would be 3 to 4 of us there. And that was an unbelievable time at work done, because you show up in the morning and there's just a gigantic pile of lumber there that the lumber company dropped off in the driveway. We would have to open it up and spread it all out, break it down, and start building. So I appreciated the fact that we never got called back on a job because the quality wasn't there. So it wasn't good enough that we had to build the garage very quickly, but you had to do it right. And if you did something and it wasn't right, my dad would make you do it again. And you definitely didn't want to have to tear something down and then rebuild it. But so anyway, that's kind of how I look at investing. Everything, actually. I look at, okay, what needs to be done? What do we need to do? And what's the most efficient way of getting that done without sacrificing quality? And it's possible. It's actually possible to be done. And one of the things I like about financial markets, when you're looking for sources of income, there are more now than there have ever been. I mean, there's unbelievable number of products that have been introduced over the past 10 to 15 years, over the past 5 years. Thousands and thousands of funds, which means the individual securities that they're putting into those go into the tens of thousands. So is that a good thing? I'm not really sure. It gives you an awful lot of options, but a lot of them have some big similarities, and then some of them are very different. In fact, I was reading, this is crazy. The Wall Street Journal, they put out an article, and I don't need to talk about who it was that was the author of the story, but they are encouraging people to trade short-term options. And an option, if you don't know what it is, it gives you the right to buy or sell something at a specific price over a specific time period. So let's say you wanted to buy an option on ABC Company, and it's selling at $100 a share, or it could be $10 a share. I don't really care. But at $100 a share, maybe they're going to charge you $5 for the right to buy it at $100. We will hold it at $100 for you for the next 60 days. I'm making all this up, by the way, but that's basically just to give you an idea of how it works. So over the next 2 months, I've got the right to buy that stock at $100. If it goes to $200, I can buy it at $100 and sell it at $200. I've turned my $5 into $100. $5 cost basis, my profit is $95. Okay. If the stock crashed instead, let's say it goes from $100 down to $50 over the next couple of months, then I've only lost $5. And a lot of people think that, yeah, wow, that's great. And I used to think it was pretty good. But see, the people that are figuring out what to charge that $5, that $5, by the way, for most stocks it's going to be a lot more than that. Probably over that time period, you're looking at somewhere around $10 to $15, depending on the day and the activity and the options during that time period. So it's I just got texted twice on my phone, the one I'm doing the show on. Sorry about that. So if you have options in right now, that the price on the option is so high that it's just really hard to do. But the bottom line is, I just wanted you to kind of get an idea of what people are doing. It's not a smart thing to do as far as I'm concerned. But and it depends. The Wall Street Journal's glorifying how this reporter, she looks like she's in her late 20s, maybe mid 20s, and she's talking about this, how much she made on this one particular contract. And I'm like, yeah, somebody's going to win the lottery too. And it's not going to be skill. It's going to be luck. And, I've done that. I've played that game. I had an options principles license. You know how few people in the country have that or even sit for that stupid exam? And I say that was one of the harder exams I've ever taken. And because it's really complicated and it's incredibly difficult to make a lot of money. And if I look back over everything I've ever spent on that, yeah, it's been very profitable for me. Also, why my hair was completely gray at the age of 40. And very stressful. And you can get hurt really badly. It's a legalized form of gambling. That's all it is. It's a legalized form of gambling that you can do at your home. And now they got these kids, setting up these accounts. And that's going to be tragic. It's already been tragic. Go to Google that for a lot of young people. Would not recommend that as a strategy. If you've got money to burn and you're too old to get on a plane to go to Vegas, maybe. I'm just kidding. Yeah, I would say find something better to do with that money. And there are lots of good things that you can do with the money. Yeah, I think if you're looking around now, if you're looking for retirement income, then you definitely don't want to look at those things. You want to look at things that have guaranteed incomes. Those are pretty good. A vast majority of them, there are different types of annuities out there, and there are thousands of types of annuities. And I'm not kidding. There are literally thousands. There are more different types of annuities than there are stocks. Why? Well, because over time, the insurance companies that participate in that market come out with new products. They on average, I would say it's probably somewhere around 2 or 3 a year. They're coming up with 2 or 3 new products, brand new. You got to go read the instructions. Are basically the prospectuses. They don't even call them prospectuses because they're insurance products. But your contracts, a sample contract, you need to read that. You need to find out what are the guarantees, what are the prohibitions. Most of them have some restrictions as to how much money you can take out over which time period. So you got to match up. Try to find out what you're looking for. You're probably not going to find something that does everything that you want it to do, but for a lot of cases, it's going to get you where you need to go, and you need to try to figure that out. And that's one of the reasons I think my job is relatively safe, even with AI coming down, because AI doesn't know who you are as a person. If you tell it exactly, if you know exactly what you're looking for, because you have a bunch of knowledge on these subjects, then it can go get whatever you want it to. But oftentimes it's a little bit more important to kind of take a look at your whole picture. It doesn't need to be complicated, but it does need to be comprehensive. And that's kind of back to the story I started with. Building a garage or room addition, when you've done it a gazillion times, is really not all that complicated. Now, somebody doing it for the first time, there's a lot to know there. But after you've been doing it for a long time, it's really just not that hard. And pretty much you know what you're up against, and so you make adjustments. You're using a different type of siding, and you know that siding has a tendency to break the nails or bend the nails that you were using. Here's a different class of nails that you could use. Same thing with investing. You are getting something and it's a little too volatile for you. Talk to your advisor. See if there's anything out there. Can I get this kind of return, and what kind of risk would I have to take? I'll give you an example. I'm a 62. I'm looking at 67 is my full Social Security age, and I fully expect over the next 5 or 6 years they may end up pushing that number out a little bit further, but that's okay. It's not a big deal. Anyway, if I had retired, if I was planning on retiring at full Social Security age, for every $100,000 that I invested, for that first $100,000 I invest, the guaranteed income on this particular contract, and this one's from Nationwide, and if you want to see the website, you can email me, and I will email you back a link, and you just click on that link in the email, and it'll bring you right to this page. Okay? And this page is when you fill in the data, then you'll hit select, and it'll give you a graph. And I'm looking at a graph now. Somebody who is 61 today, going to be 67 here in 6 more years, just wants to see, well, if I put $100,000 in there, how much income could I get? And the income that you can get is $10,665. I just realized I got to take a fairly quick commercial break coming up here. Hey, Josh, how am I doing? Do I need to get off? Okay, so, okay. All right, well, I'm going to hang on, guys. I'll be right back. This is kind of important information. I think you'll really like it, too. This is Bill Bullington right here on 1420. Stay tuned. Be right back.
Too scared to move and walk out of this tomb.
Well, welcome back. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. If you have a question that you would like to pose, please feel free to go to my website, bullingtoncapital.com. And I thought I would mention, I have to be careful. If you're not a licensed tax preparer, you're not allowed to give tax advice. And over the radio, that can be very tricky. And I did have somebody asking about a special type of annuity, and they call them a qualified longevity annuity contract. And without naming the person, because I didn't get permission, I'm going to have to say, I did get a form, and I think I might have sent it. If you haven't seen it, it just came through. It was a report that was put out by Nationwide regarding the qualified longevity annuities. Anyway, the bottom line is, instead of boring you with all the details, I'm just going to hit some of the highlights. And the highlights are this. You've got money in an IRA or a 401k or anything that you've been able to deduct from your income and contribute to. They call them qualified plans. IRAs qualify for that. Roth IRAs doesn't really matter, but if you've got one of those, there is a potential for you to save a little bit of money on taxes by buying this annuity, because it takes the annuity out of the IRA for purposes of calculating your required minimum distribution. Now, you're limited as to how much you can do. Okay? Now, I think the current limit's $200,000. I'll have to double check that. But so, in other words, you might be able to take $200,000 and buy one of these annuities, and then that won't count anymore on your as an asset when you calculate the required minimum distribution. That's a big break. That's a really big break. So those are just the basics. And again, I'm not licensed to give tax advice, so I'm going to tell you anything you hear on this show. Listen to my disclaimers. Check this out with a licensed tax preparer. That's an investment advisor is not a tax preparer. We have to know something about taxes, but it's nowhere near the level that you would need to be a professional in that space. Ours relates specifically towards investments, and he was like, well, that's an investment. Yes, it is, but it also affects the income that you have to report to the IRS. Therefore, it could be considered as tax advice, and it's a mess. The whole industry is a mess. That's what happens when anything goes through Congress. It just gets complicated in a hurry. But anyway, if you wanted to see that, it is a pretty cool idea. I mean, if you don't need the money, and you can take up to $200,000 and defer it, I think you still have to take it by the time you're age 85. But if you didn't have to take it, at 72, 73, whenever you were born and whenever it's required that you take the RMDs, required minimum distributions, it might save you some dough. I mean, think about that. If you, let's say you're getting 5% on $200,000, that's $10,000 or your withdrawal rate, 5%. And you'd be up in your late 80s, early 90s in that rate. But let's say it's just 3.5%. So that's $7,000 potentially that you would not have to include in your income. You would not have to pay taxes on that year. Now, you're going to have to pay it at some point in time. You're putting it off, though. Anyway, that's probably about as clear as mud. If you really want to talk about it, I can talk to you about it. I can send you a copy of the article I got. And, I'll tell you what, nothing is as constant as change, especially when it comes to financial markets and finances and internal revenue code. That employs an outrageous number of people, and I really wish, I wish they would just leave them on, just say, okay, we're going to simplify this. We're going to go to a flat tax on everything. It's going to be small, but you're not going to have any write-offs, so that way everybody pays the same. Yeah, I know that's not realistic, by the way, but sure would be nice. And I know I've told this story a million times, but I'm going to tell it again anyway. I found a tax return, and I thought, this is how tax returns should be. I was working with my dad. We were tearing off the roof of a house to build a dormer. That's a room addition that you're putting up on top of the house and in the attic. And anyway, I see this. They had stuffed newspapers in between the rafters and in the overhangs and the eaves for insulation. And this newspaper was from the mid-1940s. And I was like, wow, that's pretty cool. It was still in really good shape. And I took it out and I started looking at it. and I go down to what looked like a big coupon on the lower right-hand corner of one of the pages. And by the way, lower right-hand corner is almost the first page you would see when you're going through a newspaper. So they put the important stuff down there, and if you're an advertiser, they charge you a premium for that spot. And sure didn't need to know any of that stuff, but down there was what looked like a coupon, and it was actually a tax return. And I was laughing. I'm thinking, wow, this is wild. How much money did you make? Okay, multiply that by this percentage and send that in. That tax return, it took like 2 or 3 minutes, and you cut it out of the newspaper. And I was thinking to myself right then, that's how the taxes should be. It should literally be that simple. And every time I say that, I know, anybody that does taxes for a living, by the way, calm down. The chances of that ever happening, I have just given up on. I thought, when I think I was a sophomore. I was probably 20 years old when I took that class. I thought for sure that they would see the folly in having all these rules and regulations when it could be done so much simpler and save everybody a lot of stress and a lot of money, a lot of aggravation. And I just did not know how politics worked or how income tax accountants and attorneys, would fight to save their jobs and actually create even more work. And, I was just pretty naive. So anyway, long story short, I want to try to keep things as simple as possible when it comes to your investing. It's not always easy to do. And that's one of the reasons I have a job. And there are only, tens of thousands of funds available out there, which they've got different characteristics. And that's what we do. We look at things like this qualified longevity annuity contract that came out. And, it's a lot of effort. And I think I've learned more from researching things people have sent me questions on through this radio show than I ever have learned in books, by far. So experience is actually, it's a pretty good thing. I really appreciate it after all the years. It is very difficult. Learning a lot of this stuff, not always that easy. But so again, if you have any questions, just feel free to put them out there. Realistically, folks, here's what matters most. When you get close to retirement, you need to start thinking in terms of, okay, how much do I really need to pay my basic expenses? And I oftentimes I see people have a pretty good idea of how much they're spending. In most cases, when they're up in their, I would say probably the late 40s, mid 50s. Yeah, they have a pretty good idea of what that is. Now, I have been seeing families who have children and they had them later and are still paying for college at that point. And that's rough. I'm going to tell you, college is not inexpensive. So a little bit, it's constraining, but it is what it is. You just take those expenses and add it into what you need to generate an income. Take a look at what you're going to get from Social Security or other pension plan. You can subtract that from that dollar amount that you've got there. The remainder of it, that's what you have to finance. And I know that probably, if you're driving your car, that probably doesn't make a whole lot of sense because you're driving in your car, hopefully you're paying attention. Not like me. I'm just kidding. But so you've got assets, income, and you add those two together. Add the income, add 4% of what the assets are to your income, whatever it is, Social Security and pension, and there you go. Now, if it's insufficient, that's where you got to start getting creative. In other words, maybe cutting back. And what's really funny is I see a lot of people who have they will never spend their money. Yeah, because they just are good savers, and I call it the squirrel gene. They get money, they put it away, and I've got quite a few clients like that. Who basically, they will never outlive their money. Their biggest problem is who are they going to leave it to, and so it's all over the spectrum. And anyway, just for some basic guidelines, one of the reasons I like the annuities is they give you a good solid number. That number is incredibly difficult to match on an on an after expense basis. If I get $100,000 and I'm only I'm 61 now, and I want to take I'm going to get $10,665 when I'm age 67, supplement Social Security and whatever else I've got going on at that time. That's actually from what you started with. I know it's got I'm not going to go through the internal rate of return experience with you here, but what you started with, $100,000, that's 10.6% of what you started with. And that was 6 years ago. So how much would you have to grow your investments by to be able to generate that type of income over that time period? Well, that has a whole bunch of other factors in it. Now, we'll come back to that at some point in time in the future and actually do the math on that. But it's a big number. You have to, not only do you have to save a lot, you've got to earn decent returns on that. And here's what is really difficult about this. The S&P 500, which is in the top 10% of all funds, you look over the past 40 or 50 years, the S&P 500 finishes in the top 10% of all funds over that time period. And so it's very difficult to outperform. And one of the reasons it's difficult to outperform is that it is aggressive. Okay? It's aggressive. And, I don't know, it's a little tiring, I would say, to somebody says, well, you might as well just buy the S&P 500. Well, okay. If you're willing to see that stock portion of your portfolio drop by 50% or more, okay, and you're willing to go through a 10-year time period that had negative return, fine. By all means, do the S&P 500. I like the Russell 1000 Growth. It's got a better track record than that does one of the few funds out there, or indexes out there. And but it also is going to be incredibly volatile. And a reason I keep coming back to this is I just, after all these years, I can't believe I still get the same questions. But okay, so they should start teaching this, and they should have started teaching this, probably in 7th grade. They should start teaching it in 7th grade. They're still not teaching it even in high school that much. Some high schools have a pretty good program. But the volatility that is involved in generating returns that are above 5 or 6% is enormous. And for an awful lot of people, it's not even worth it. For the stress that it puts people under. I hear it in their voices. I get the call. Hey, and you can hear that it is palpable, the stress that they're under. So, and that's a very important part of investing, is making sure that you're ready for the types of investments that you're going to be making. And when I see an article like, this is so, there are no disclaimers. See, that's the thing about having a newspaper like the Wall Street Journal. You're not licensed to give out advice. You're not licensed to actually participate and manage money. Therefore, you don't have to watch what you're saying. It's covered under the right to free speech and journalism. So these guys are saying a lot of things, and they're not talking about all the risks. And yeah, in their defense, they did say part of their, in that article, here's the third paragraph, part of their appeal and risk is that is that the contracts can be like placing chips at a roulette table or buying a scratch-off lottery ticket. Well, see, scratch-off lottery tickets, they don't allow to, for you to put your life savings in there, nobody does that. But now that they've read about this one, they might. Anyway, there's potential for huge, nearly instantaneous gains or the loss of everything you put down. So, and that's pretty good. But I'm telling you, when people are reading this, they're not focusing on that. They're focusing on the fact that this lady went in and put $500 down and, made a ton of money. And they don't talk about all the times that they don't make money. And believe me, I've probably, the rate of return on these types of investments for me has probably been the highest of anything I've done. The problem is it's very lumpy. You can go for months with losing trades, and then you can get really lucky. And by the way, there's always a large element of luck involved. There's some skill involved. And if it were all skill, then someone would already have all the money in the world, and these markets would not exist. Okay, so the market makers, well, they're always making money. Yeah, they're the house. There's a thing called a spread. That's what they get. They get paid just to allow you to make the bet, and they are bets. Don't let anybody kid you. You're going to buy an option. It's a bet. And anyway, so I'm glad the girl made a bet and it paid off. I would also say, keep that to a really small percentage of your portfolio. When you get close to retirement, and unless you're extremely wealthy, don't do it. It's not. It's not a really smart thing to do. Even the covered calls, and I know I'm probably picking off all the people that like to do covered calls out there, but all three of you. But it's not easy to do. So anyway, it's literally the opposite extreme. I mean, when you take an annuity that's going to guarantee an income, it's only as strong as the underlying insurance company, by the way. So you want to make sure that do the best you can doing the due diligence. During the 2008, a couple of really big insurance companies actually went away. Not a ton, and they're highly regulated, especially when they've got a lot of fixed contracts in their book of business when they get audited. So they have rules that they have to go by, and they try to make sure that they can pay that off a lot better than a lot of other types of fixed income things I see. If you see something fixed income, what's been really popular coming across my desk over the past few months has been a real estate investment trust of different types. Well, that's a stock, and you're investing in stock of a company that invests in real estate, directly in real estate, not like directly in treasuries, from the government. They're investing in mortgages or the actual property themselves. So there's a lot more risk in something like that's more like a normal stock than it is something that's got higher guarantees. But the guarantees on annuities, the insurance companies are getting audited, and they've got to be very conservative with those things. And the highest level of safety that you can get is probably going to be a treasury, because that comes directly, that's a direct obligation of the United States government. So that's the highest. That's all the highest level of safety. It's also why the rates aren't quite as high as some of the others, because there is the element of risk. If an insurance company went away, they might not be able to pay the full payout. I think I have to take a real quick commercial break here. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. If you guys want to call in, 216-901-0945. When I come back, we'll have about 15 more minutes, and then I will let you go.
Face down in the desert now, there's a gate locked around my... The other day I was thinking to myself, made a list of all my mistakes.
This is Bill Bullington here every morning from Saturday, from 11 on Saturday. You know, life is kind of chaotic. Yeah, I was trying to pull up some charts while I was speaking at the same time, and then the music's still in my ear. That's a little difficult, but that's okay. It was kind of like normal life, you know? Yeah, 3 things going on at once. But anyway, I got to get another seminar on the calendar. I have to do that. You know, I had to stop because of the pandemic, and even up until just a few months ago, they were having space apart that it really would not have made a whole lot of sense. But we'll get one on the schedule here. And if you'd like to come in and talk about your own personal situation, please feel free to do that. And I like to think I try to make things as simple as possible. And I feel bad. I have clients coming in, or potential clients and clients, and their stuff is not super well organized. And it really doesn't take that much. I mean, a list, you know, a basic spreadsheet. That's basically what I do. I fill it in by hand. I don't like the software that's out there, and some of it, by the way, can expose you to risk, like significant risk, especially the account aggregators. That's just a lot of risk. And by the way, the custodians that I use, they will let you use their aggregators. They're not mine. I've talked with my compliance guy and the guy from the Ohio Department of Securities that comes out and audits our firm, and he's like, yeah, I wouldn't do it. that was his, well, kind of where he hinted towards that. So I was like, yeah, okay, I can take the hint. He wasn't as blunt as I was. But there's a lot of stuff going on. You want to make sure that, you know, the custodians that you're dealing with have huge budgets for trying to protect their clients' data and their information. And so for me to be able to offer you a separate view than the one you're going to get from them that's as safe as the one that they're providing, that's just not happening. It's just not, you know, you're talking a couple $100,000 for a firm of my size a year just for the software, now that I've gotten some answers back on that. So how do we work with people? Well, let's say, for example, I use Fidelity, Axos, big online bank, and Goldman Sachs. I like Fidelity the best. Fidelity, we give our clients a choice, but I like Fidelity the best. It's they're faster. They got a huge staff. You have questions, and we're not in the office. There's an 800 number you can call. But normally I'm going to pick up anyway. And that guy pick up calls. I ask my clients, call me over the weekend, you know, 9 o'clock on a Saturday once, 9 o'clock at night. And I'm like, oh, yeah, Bullington Capital. But I really wasn't doing anything. So I wouldn't do that often, but, you know, it really depends on how nice you are. And so anyway, bottom line is, you know, there's a lot of service, and there are a lot of services that are available through your these custodians that people that are just going directly to the firms are not always aware of, and that's been kind of interesting. So what would that be? Well, there's lending. They'll lend you money against your securities. I wouldn't recommend doing that, by the way, but in a pinch, we've had to do that for a couple of our bigger clients, and it wasn't unsubstantial, and it happened to save them some money. Knock on wood, we got lucky, but they needed short-term lending. They just borrowed against some of their accounts and then paid it back. And the interest that they paid was not that much because they didn't have it that much, but they just needed the money fast, and it was the quickest way to get it. So I was glad to be able to help them out. I'm not really fond of doing stuff like that. But the other thing is, I got a client. This guy easily could manage his own money, and I'm very pleased, very happy that he chooses us and has us working with him. And he's doing some longer-term trading, which is kind of what I do with a very small portion of my money. It's less than 20% of my money anymore. But there are these things I used to do most of my money with when I was a young man because I had time. And if you have time, then I can show you stuff that, if you want to go out and get a subscription, I show you my scans. I can set them up on your software for you, and you can look at the same things that I'm looking at. It's one of the reasons I just don't get very upset with financial markets. When you're looking at this stuff every day, by the way, it is addictive. It is. It's like other bad habits. I think I spend too much time at night going through charts and looking at it. But, bottom line, at this stage of the game, I don't have a whole lot else to do. So what the heck? But, I've always been that way. And it can be kind of addicting because it's a very old strategy that works very well, but only if you stick to the rules. And having said that, I'm telling you, the reasons I don't preach it and teach it every day is because it requires an enormous amount of control, emotional control. The math behind the methodology is simple, and you can see that it works. Okay? You can see that. But it doesn't work like you want it to. If you're making money on 1 out of 3 transactions, you're doing well. Okay? 1 out of 3. If you are in 85 to 90% of your gains are going to come out of less than 20% of your transactions, that means, 1 out of 5 will make a reasonably significant amount of money if you keep doing it. And by the way, those are the statistics from the past. That doesn't mean that it's going to work that way in the future. But bottom line is, if you really understand the math behind it, and it's not complicated math, then you go, oh, I see. And by the way, one of the reasons I don't do this and haven't taught it for a long time was because there are exchange-traded funds that are doing something that is so similar to what I'm doing that you're just splitting hairs. So the only reason to do something like this is that you really like it and you want to do it. You want to spend time seeing if you can compete with or the market or just make money. And if you want to do that, put that kind of time in, great. I'm going to tell you, though, I'd be better off just taking that 20% of my money and putting it into the ETFs that I have. But it's one of those things. So I understand. Like, you've got an idea and you're really excited about it, and I'm familiar with that idea, and I know that it's going to be pretty difficult, and if the odds are not in your favor, I'm going to tell you that about like I just said it. I understand you really want to do this. The odds are not in your favor. Here's why. I'll explain why, and here's what I do. But if you really want to do it, okay, then I believe you can do anything that you really want to do if you put your mind to it. Not anything, of course. I don't care how hard you flap your arms, you're probably not going to fly, especially when you weigh as much as I do. But anyway, within reasonable expectations, and I guess that can be a challenge too at times. But bottom line is, I think I've got about 5 or 6 more minutes here. I've got these scans. The next seminars that we do, I'll show them. And the software, by the way, Telechart, they're not a sponsor. They've changed dramatically, and I can show you how to set up the new scans. I just did this for one of my clients, and he gets it, and it's doable, but there is a lot to this. So I'm sure that cuts down on your learning curve if somebody comes in and sets it up for you. I can't teach you the whole thing. It takes too long. It's just like the stuff that I'm going through now. There's a screen share software. It's very popular. and it is unbelievably complicated. I'm like looking at this stuff going, what the heck? Are you kidding me? Yeah, I've got it at least 40 hours. At least 40 hours in. I'm trying to get it. And a big part of it is because the manuals are so poorly written. I mean, they're like going into a dictionary to learn English. Let's just open it up and start wherever you start. Yeah. Anyway, I only got a couple minutes here, but so if you've heard anything that you'd like more information on, like what's your life expectancy? How much could you reasonably expect to earn on your investments over that time period? What's a safe withdrawal rate? Okay. By the way, that's going to depend on a large part on how much risk you're willing to take. And I've got a really simple formula for calculating what kind of risk taker you are, but I'm out of time. So I'll have to go through that next week, or you can just call me if you'd like to, 330-664-0700, or you can go to my website, bullingtoncapital.com, or you can email me, bill@bullingtoncapital.com. And with that, I'm going to sign off here. Thanks for listening, everybody. I'll be back next Saturday morning. Have a good week, good investing, and good luck.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.